Yo, what's good everyone? Welcome to the final section of part 3 of this course. Today's video, we're going to be discussing, the basic Forex trading terminology and the Forex sessions. So by now, I'm sure through the previous videos, maybe I've said some terms or some things that, didn't really click with you, or you're kind of thinking, what the hell is this guy talking about? I have no idea, and I get it. You're probably stepping into an industry that you know nothing about, or you're just diving into something that's completely new for you. It'd be like going to the hospital and trying to perform open heart surgery with a bunch of professionals. They're going to be shouting out a bunch of terms and shit that you just don't understand. And if that's you right now, this video is perfect for you, because I'm basically going to take the most basic Forex terms and break them down as simple as possible. I'm going to try to break these down to where literally a homeless guy with half a brain could understand these. And that's what I'm going to try to do. Now, keep in mind that this video might be a little bit longer just because there are some, there's a decent amount of definitions on here, but I'm going to do my best to break these down as simple as possible. I do have the definitions by book on here, but I'm just going to take the terms and then break them down kind of in my own words and hopefully make them as simple as possible. That way you can understand them. So the first term is a pip. A pip is the unit of measurement to express the change in value between two currencies. It's usually the last decimal place of a price quote. So in the past video, I think it was last video, where I discussed, that Forex currencies are quoted in pairs, and then it was right next to Euro USD. It was the number, it was like 1.1 something something, okay? That is called the exchange rate. The fluctuation of that exchange rate as it goes up or down, the way you measure that is with pips. So, for example, Euro USD, let's say Euro USD moves from 1.1050 to 1.1051. All that's saying is it increased 1 pip. This fluctuation of this currency, this exchange rate, it increased 1 pip. So if somebody came in and said, yo, I caught 30 pips on Euro USD, all they're saying is price moved from 1.1050 and it moved to 1.1080. That's 30 pips. All that is a measurement of pips. Okay, the next term is a lot size. A lot, you're going to hear people say like, oh, I put a lot on USD, US 30 or whatever, you're going to hear a lot. So lot size is basically a unit measuring a transaction. Your standard size for a lot is 100,000 units of currency. I'm not going to really dive into that one too much because I'm going to talk about it later in the course. But just know that a lot size is basically what you input before you press buy or sell on a trade. And it shows, how much of that currency you are going to be buying. So if, somebody says, I bought a standard lot, or I bought standards, or I just bought a lot, it's literally represented as 1.00. That's all you need to know for now. We'll dive into it in a little bit. So a broker, the next term, a broker, it's a financial services company that provides traders access to a platform for buying and selling foreign currencies. So this is where you're going to have your trading capital stored. For example, let's say you give me $1,000 and you tell me what to do, like buying and selling certain things. Let's say you're a sneakerhead or whatever, and you're telling me what shoes to buy and when to sell them and whatnot, and you make profit. Okay, I'm going to charge you a commission because I performed this service for you of buying and selling. That's all a broker is. A broker allows you to store your money with them, and when you press buy and sell, you're telling them what to do, and all they're doing is inputting your orders into the financial markets. And then based off if you make money or whatnot, they make profit. And they make money based off of commissions and spreads. So with that being said, we'll go to the next one. I'm not going to read these definitions because it's probably not going to make sense right now. I'm going to try to break it down a little more simple. So you have the ask price, the bid price, and then the spread. The spread is the difference between the ask price and the bid price, and this is the transaction cost. This is one of the ways that the broker makes money, is based off of the spread. So for example, when you go to buy into a let's say you're wanting to buy Euro USD in this example. If you're wanting to buy it, you're not going to get in at 1.1051. You're getting in at 1.1053. The difference between that is the spread, and it's represented in pips. You go to the last decimal place, as we just talked about in the definition on pips. The difference between these two numbers is 2 pips. So that's the spread. You're getting in 2 pips away from where you ideally wanted to be in. That's all that is. And then it's the same thing if you wanted to sell. If you wanted to sell, you're not getting in right here. You're getting in right here, which is the same thing. It's a 2 pip spread. Just know those are the basics. Along with spreads, I choose my brokers based off of, I want tight spreads, low spreads. I'll pay a higher commission, but I want low spreads because For me being an intraday trader blended with scalper, I target, smaller moves. So I can't be giving up 2-3 pips in spread when my overall target move is 30 pips. Like, that's crazy. Like, I need like very low to literally no spread. That's ideal for me. Other people, like swing traders, they don't like giving up a ton of commissions or, whatever. You just need to figure that out for you when you pick your broker. We'll talk about that in a later video. But just for now, these are the basics of the bid, the ask, and the spread. So moving on, indices. Indices are, I guess you could say, like a big time, I don't know, everybody, I guess, is like I don't know why, but when people come into this industry, they're like really like horny to trade like indices or whatever. I guess just because they move fast and whatnot. I personally don't trade indices, but like I know like a lot of people make a lot of money off indices, and that's why I guess like the allure to trading indices. But just know that indices are a measurement of the price performance of a group of stocks. So for example, the Dow Jones, in the stock market, the Dow Jones is the 30 top companies listed on stock exchanges in the United States. So like when you go on the news and they're saying, oh, the Dow's down 400 points, they're referring to US 30. In our markets, it's called US 30. It's the same exact thing as the Dow Jones. It's the Dow Jones, right? It's the top 30 performing companies in the United States. And basically all you're doing is you're trading. So like in the stock market, when they say the Dow's down 400 points, in Forex, it's, pips. Like that's it. And you're just trading those fluctuations of price. The next term is stop loss and take profit. I'm going to kind of define these together. Basically, stop loss gets you out of the trade if it goes against you. Take profit gets you out of the trade if the trade goes for you. For example, this trade right here is one I took, I believe, 2 weeks ago. I'm not going to explain why I got in this move or anything other than what the stop loss and take profit is. So the stop loss is here in case this goes against me. So I got in right here where the green meets the red. That's where I got in. My stop loss is down here. If price went down here and hit this area, it would automatically take me out of the trade. Like I did not input, take me out or anything like that. It takes me out of the trade. But that's where I set my stop loss, and you set that there because basically if price hit this area, it would invalidate the trade. I don't want to be in the trade anymore. So stop loss is there to save you from your own trading errors, and that's why I was saying in the psychology section, when you move this, your losses get bigger and bigger and bigger. So when you set your stop loss, it stays there. The second thing was the take profit. The take profit was obviously up here. It could have been right here, wherever. Wherever you try to enter these numbers, basically all that's saying is if price hits that area, it's going to take you out. Now, ideally, you want to set your take profit at an area of a desired location. For example, you want to be targeting, I'm not going to explain it too much because that's what the next section's for, but like you're targeting, a supply and demand zone, support and resistance zone, a previous market structure area, or an idea of like if price hits here, the move's done and it could, pull back on me. That's what a take profit is. That's what a stop loss is. Diving into 4 new terms. One that's not on here is market execution. Just know that market execution is you actively entering the trade. Like you go to your phone or your MetaTrader on your computer and you type or you press buy or sell. That's market execution. You're getting right where the market is right now. Now these 4 terms are called pending orders. So basically a pending order is you enter it and you're saying, basically all you're doing is you're saying, if price does this, I want to get in here. Okay, so I'm not going to break these down too much because it's literally right here, just read, you know what I'm saying? But like a buy stop is basically saying if price gets here, so like the blue dot is price is here, and you're saying if price hits here, I want to be in. So you enter this order, and then when price hits that, you buy. It puts you on a buy, automatically puts you in the order on a buy. Right here, ideally you want it to go up. Sell stops the reverse. So price is above the area. You're saying if price hits here, that's an area of interest. I want to sell from that. If price hits it, it breaks through, you sell. Very simple. Buy limit, basically you're bouncing off the floor. Sell limit, you're bouncing off the ceiling. That's the most basic way. So basically in this scenario on the buy limit, price is up here. You're saying if price comes down here, that's an area of interest for me. I want to buy right there. You place the order. If it hits it, you buy in. Hopefully it goes for you. That's basically all pending orders are. So the next thing is the trading sessions. So as you can see on this chart, there are 4 major trading sessions. There's the Sydney session, the Tokyo session, the London session, and the New York session. Based off what session you trade, there's going to be more or less volume. And obviously, as you can see here, some of these sessions overlap each other. So down here is Eastern Standard Time. As you can see, I don't really trade Sydney or Tokyo because there's just not enough volume for me to trade them, so I don't really care about them. I also don't trade New York session because I only trade one session. But that's just me. It fits my schedule, it fits my lifestyle, and that's what I do. But as you can see here, London session starts at 3 a.m. Eastern Standard Time for me. It was definitely tough to start doing, but now that I'm in it, it's lit. But anyway, so London starts at 3 a.m., ends at like 11 or 12, but I'm typically off the charts by 5. New York session starts at 8 a.m., carries throughout, the New York session, ends at, 4:30, same as the stock market. Also with the New York session, you also have to factor in that the stock market opens at 9:30, so you have an hour and a half window before the stock market opens. And typically in this crossover, the New York session, you're going to experience the most volume right at the end of lunch, or basically the end of lunch for the people who trade London session. They're coming back from lunch, and then the start of New York session, people are waking up, hitting the charts and stuff like that. These are when you're going to have the most volume. I typically recommend one of these two sessions just because there is the most volume, and that's where your move's going to happen. Now, in the previous video, we discussed, why I chose Forex, and it was because of, the flexibility of the schedule. You can pick, kind of what trading session you want to trade based off of, what time of day fits your lifestyle, right? But just because the market's open 24 hours a day doesn't mean you need to be in front of the charts every single second of every single day. You just don't have to, right? I trade the London session, and I'm actively on the charts for a max of an hour and a half a day. Like, that's maxed. If I'm on longer than an hour and a half, I'm doing something wrong and I'm violating my trading plan, right? In most days, I'm on the charts in between 15 and 45 minutes. Like, that's the reality of my trading strategy and my trading. It just fits me, right? And to be honest, guys, I don't care about the New York session or any of these other trading sessions. I don't care what's happening. Price can do literally whatever it wants. All I care about is 2:45 a.m. to 4:30 a.m. Eastern Standard Time. The rest of the day, I'm free to work on other things, or just golf or hang out with friends or do whatever I wanted to do. That's the best part about Forex and trading, is just because like you have ultimate freedom to do whatever you want whenever you want to do it. So if you want to know more about the basics of Forex, understand that it's totally not necessary. We've talked about in the psychology section, you don't need to know everything about everything, but if you want to, you can go to babypips.com, and it's a free course. It goes over all kinds of just basic information. I've personally done the course. It is insightful. There's some good shit in there, but it's just not necessary if you don't want to. Do I recommend it? Sure, go for it. The more the better, I guess. No, not really, but you know what I'm saying? Like, they do have a lot of good stuff. Like, if certain things don't make sense, like what we just discussed, go there. They break it down really easy, and they talk about a lot. They do have some good shit in there for sure. So if that's you and you want to go to babypips.com, take their free course. Awesome. Okay, wrapping up Forex basics, understand that, look, there's no best pair, there's no best session, and there's no best way to trade. Just, it's entirely up to you. It's whatever you see, whatever you feel, whatever fits you, right? That's the beauty of trading, is it's so flexible. You can trade whatever pair you want, you can trade it however you want, you can do it whatever time of the day. Just understand that, certain pairs are going to move during certain sessions, okay? I trade one pair. I trade GJ. I don't look at anything else. I look at GBP, JPY. That's the only pair I trade. I don't care what indices are doing. I don't care what gold's doing. I don't care what Euro USD's. I don't care. I look at one freaking pair, right? And I trade one session. I trade London session. I already told you, I don't care what price does during New York or Asian or Tokyo. None of that. I don't care. Okay, I trade one session. I trade one pair. I trade one style of trading. I trade intraday. That's it. I don't try to swing trade just out of the blue, like, oh shit, I'm gonna get in a position and ride it out for a week. Like, that's not me, bro. Like, I trade one session, one pair, one style, and I trade one move. I'm looking for one thing every single day, and that's it. And it's the same thing, rinse, repeat, bread and butter every single day. It's the exact same. Okay? And that's all trading is. You got to find out what's best for you. There is no best way. There's only a best way for you. And what your goal as a trader is to find that best way and master it. With that being said, guys, that is it for Forex Basics. I will see you guys in the next video. Peace.